Welcome, everyone. I'm Chris Clow, editor with HW Media and Reverse Mortgage Daily, stepping in for Sarah Wheeler. Today on HousingWire Daily, we're speaking with HousingWire lead analyst Logan Mohtashami, who discusses the impending meeting next week of the Fed and what we might be able to expect from rates and their overall policy thinking based on the latest economic data. Hope you enjoy it. Logan, welcome back to HousingWire Daily. Good to see you again. It's been a while since it's been you and me.
Yes, and they're actually starting the Deadpool Wolverine movie again. So you and I are going to be happy that that's going to come out soon.
Absolutely. No, it's definitely something to look forward to. And something else to look forward to, apparently, is the Fed meeting next week, right?
Yes, this is going to be a big one. Even though there's nothing going to be done at this Fed meeting, the language is very critical. So the reason I talk about this right now is that the 10-year yield is at a very key critical point again. And if I look at the charts, this thing looks like it wants to break out, but we're at a very key level that we usually have bounced off from. So the Fed meeting right now is going to be very critical in the sense that last year at this time, when we were at this key level for the bond market and mortgage rates, the Fed went really hawkish for some reason. The bond market was heavily shorted and the 10-year yield shot up to 5% and we had 8% mortgage rates. Now that we're going into spring, mortgage rates are, 7%. Can this happen again? Can they do another carbon copy print while keep on telling people that, oh yeah, we're restrictive policy. We don't want to do that. And this for me is just so much of my work going back to 2022 when I kind of got a sense that the Fed was like, whoa, for some reason, they're going to be very, very hawkish for a long time, longer than anybody thought. And even with the growth rate of inflation falling, and I encourage everyone, go look at CPI, PPI inflation, PC. The year-over-year data has made unbelievable moves, but we're still here with 7% mortgage rates with a 10-year yield above 4%. But here's a critical level right here. If they truly wanted to, profess that, oh, we're very restrictive policies, we don't want to do that anymore, then the next Fed meeting, the language will be very key, because if they go hawkish again, that 10-year yield is going to break that level. We're going to have, head towards 7.5 to 8% mortgage rates again. And the Fed's going to go, I don't know what happened. We don't want this. With the growth rate of inflation on a year-over-year average being having so much progress, the ball is in their courts. And staying true to myself, I've always said the Fed won't really pivot until the labor market breaks. And that is jobless claims rising. And jobless claims, the headline, the 4-week moving average are still near historical lows.
Yeah, absolutely. So it looks like current target range based on the information I've seen is 5.25% to 5.5, which isn't expected to change. And then, of course, Chair Powell is going to give his press conference that describes sort of what they're thinking in the current environment. Is there anything in particular you expect him to bring to the table when he has the floor?
The Fed has said that what happened last year was very restrictive policy, right? And I always say that the housing market has extremely restrictive policy. We are in the third calendar year of the lowest home sales ever. Don't compare this to the great financial recession, because back then we had a lot less people. Demographics were bad. The credit market was broken. And here demographics are good. We have a lot more people working, and the credit market isn't broken anymore. Freddie and Fannie are in conservatorship already. So there are still people being able to lend. And I think they got caught because from my point of view, they had forecasted a recession in 2023. You don't have a 4.5 to 4.6% unemployment rate as your forecast and not basically say, we believe a recession is going to happen. Well, a recession didn't happen, right? Not only that, the economy, even with all the rate hikes, the economy grew above trend. The stock market rebounded. Jobless claims are low, right? So they're kind of in this spot. They're like, oh, well, this didn't work. What do we do now? And this is why I always go back to Neil Kashkari's interview on CNBC in February, when he said 6% mortgage rates are a problem. That is code like we want to keep home sales depressed as long as we can. But when the labor market starts to break, when jobless claims starts to break, the bond market will bring yields down, mortgage rates will come down, and that will do the heavy lifting. Well, it's 2024, right? claims aren't breaking. Existing home sales are so low right now that the White House has to do something to try to help the marketplace, which is not a good thing in the first part. So it's just the language is going to be really critical, because if they stick to well, we have to be part of our dual mandate, well, they have to cut this year because their own models show them to be very restrictive. And 3 rate cuts isn't anything big, right? We've had these really big moves in mortgage rates lower without any rate cuts even happening. But it goes into this equilibrium between the labor data is actually more important than the inflation data. And this is why for a long time I said paper, rock, scissors. You want to take labor over the scissors inflation data, because the growth rate of inflation and year-over-year data has fallen so much, but it doesn't matter here because the labor market has always been the key.
I took a look at a speech that Michelle Bowman gave last week, where it seemed like she struck a little bit more of a hawkish tone related to inflation compared to Chair Powell. She didn't think that they're not nearly at the inflation level that would justify a rate cut yet. And she even seemed to suggest that, if they reduce the policy rate too soon, then future rate increases could happen over the longer term. Do you have a reaction to that?
Yeah. Bowman is the hawk. So in fact, before she even gave that speech, I said, everyone heads up. She's going to say something. It's going to be very hawkish. I think another thing she said, like, we don't calculate the housing market in our inflation Fed rate hikes or cuts model. So a lot of the hawks are even talking about 2 to 3 rate cuts. 2 to 3 rate cuts, considering where the growth rate of inflation is at right now on a year-over-year basis, is nothing, right? So even if they cut rates 3 times, they are still restricted. This is why I say I'm not a Fed pivot person, because pivot to me, the first wave of the pivot were a bunch of people, stock traders, saying, oh, the Fed has to pivot because we're going to a recession. A recession's coming. This has been a graveyard of bad recession calls from the same group of people who gave graveyard recession calls in the previous decade. And that didn't work out. So I can't do that side because I haven't seen the recessionary data yet. But this takes it to another degree. Why am I not a Fed pivot person? Look at this. Look at the 10-year yield. Look at the Fed funds rate. 3 rate cuts. Not that big of a difference right now. So I think you'll have the hawks talking very hawkish. You'll have the dove people talking very dovish. But it looks like to me they still want to get those 2 to 3 rate cuts in, just because the policy is very restrictive. However, if jobless claims had been rising in the last 3 months, if we were heading toward 300,000, not to 200,000, all of us would be having a different discussion. So the Fed is using that as still a cover for, when I think President Waller said, why cut rates? The labor market is fine. They're looking at data that historically, whenever we get to this point and you stay restrictive long enough, that's when a recession typically happens. So they're trying to thread a needle here. But to me, it's just the labor data is too good for them, how they look at it. Now, I argue that the labor data now is not tight anymore. The jobs quit percentage is below pre-COVID. The jobs hire is pre-COVID. If we look at other wage indexes, we're almost back to pre-COVID. They said they did not want to see wage growth take off, right? So fine, the wage growth data is slowing down. The job openings data is down 3 million from the peak. That's their data line that they love so much. And I always, I know a lot of people don't like the job openings data. It's so much part of my work, but the Fed really believes it's hard to have a real job loss recession with job openings above 7 million. Whether you and I or anybody else disagrees with that, that's how they view it. So we have to play the guy ahead of us in the poker game. So it's just, we haven't seen the labor market break for them to be like, okay, we're going to cut rates. Our policy is now to go into neutral. When we go into neutral, then guess what? We have a Fed that's pivoted, but they're still in restrictive policy, even if they cut rates 3 times this year.
If you could get into a little bit more of a reflective mood, if you could talk to yourself at this point last year, do you think that the expectations that you had a year ago have generally panned out, or if things kind of moved in maybe a different direction than you would have expected?
It's funny. It was a year ago I went on CNBC and said, oh, by the way, the Fed is not going to be satisfied until the labor market breaks. We actually had this discussion on Twitter today. So everything is kind of held its course because for me, my economic work on cycles is that what I've seen is that a lot of people just aren't versed on how the economic cycle moves toward late expansion. And usually what occurs is housing breaks. That means residential construction workers lose their jobs because they're the first wave of jobs lost. The jobless claims data really takes off with them. That hasn't occurred, right? So a lot of people are using inverted yield curves as their recessionary indicator. Well, the inverted yield curve has not had a recession in the previous 3 cycles unless the labor market breaks for construction workers. Everything kind of looks right. That's why the 10-year yield forecast is probably a little bit higher. And rates are a little bit higher than everyone else. But I work off jobless claims, and I'm sitting here. The last jobless claims number is near 200,000, nowhere close to 323, because the residential construction side hasn't broken yet. So everything kind of looks right. But we are testing the Fed now when they have said, this is the different part from last year. Last year, they were just like, hike, hit the labor market, hit the labor. Oh my God, the 10-year yield's at 5%. What's going on? Now they're trying to say, oh, we are a restrictive policy. This is why I think this Fed meeting is more important than the other ones in the past. They have told us they are in restrictive policy. So do they make the same mistake they did last year and allowing the 10-year yield to go up? Because we actually started to see cracks, even in the new home sales market when mortgage rates got to 8%. So I want to see what they say now after they've given us a few meetings of saying, we're restrictive. We want to be less restrictive. And I think that there's the difference between what market participants want. There's a lot of people who just want to see a recession. They want the Fed to stay restrictive enough to get a recession. So I know these people are losers anyway. But here, this is different now. They've told us they're in restrictive policy. In the past, they didn't. So it comes back down to their dual mandate. They want to help make sure that the labor market is intact. Well, the labor market is softening already, right? Job openings are falling. Job quits are falling. The growth rate of the labor market is actually slowing down. It's still above my expectations. My economic work is a little bit more complicated than others on the labor market, but they're getting what they want. And here's their first real test in 2024. Do they just go, oh, no, we still have to be aggressive? Or do they actually say this time they're going to stick to it and go, we are still in restrictive policy. We still believe in cutting rates 2 to 3 times. And we'll make sure that, we want to keep the economic cycle going as long as possible. Or do they just put their heads down and go, nope, we got to break the labor market because that's the only way that we get inflation down to target?
Considering the relative economic roller coaster that the country has been on for the last few years, and now that it looks like the Fed is kind of getting what they want out of their initial policy directives, how do you feel about their management overall, particularly over the past, say, 18 months?
I'm not a big believer of creating a recession to defeat inflation. So I think what they did is they went heads first and said, okay, we're going to have a very mild recession and we'll handle it when we get there. Okay, fair enough. That didn't happen, right? We still didn't see the recessionary indicators. My problem with what the Fed did is that after 2022, they had a policy before Christmas in 2022. They talked about, we would like the Fed funds rate to mirror 3, 6, and 12-month core PCE. I was like, oh my God. I was even surprised by that. That's a very soft landing take. I remember Sarah and I were doing podcasts about that. I even wrote about this. This is really strange. Then for some reason they changed course and they started to hike rates even with the banking crisis and everything. So to me, do they get the soft landing? Because really the honest truth is, if the 10-year yield was between 3.37 and 3.80 and we had, sub 6% mortgage rates, the housing market picks up. And it's very hard to have a recession if housing is growing again, right? That's the whole housing leads you in a recession and out. So they have a layup here. So I'm basing everything on what they do is, can they get that soft landing, or was the full intention just to create a mild recession just to make sure? Because, you know, they were a single mandate before, but now they've talked about being a dual mandate. So when you go into that dual mandate, your job is now to protect the labor market. Well, the labor market is softening up a bit. So I'm going to reserve my judgment to them, because I thought the Fed did a great job in the previous expansion. We had the longest economic and job expansion ever recorded in history. They came in and stepped in COVID and everything here. But here, you can't just, you don't want to be that person that just goes, listen, I did really great here, but here I'm just going to, okay, listen, we'll just take the L here because we had so many victories. You cannot treat the American labor market that way because of some belief of the 1970s that doesn't exist, obviously. So I'm going to reserve my judgment to see how they act in 2024, because they shifted in the sense late last year, by starting to talk about, we are very restrictive policy. And here's your first test. Do they hold on to that, or do they just let that go? And all of a sudden we're back to what do you want the market to do? What do you want the labor market to do at this point? So up until now, I'm just going to say, once you go into the dual mandate talk, you've got to be careful of the inflation and labor data together. That's their mandate. There's nothing else that they do. They don't control government spending. They don't control the credit markets or anything like that. That's their dual mandate. So we are now at the point to where the labor market is softening enough for them to actually start to move the direction into a more neutral stance.
In terms of the housing professionals who do listen to this show on a regular basis and that pay attention to the coverage that HousingWire pumps out into the news cycle, are there any primary takeaways that you think they should keep their eyes most focused on as we prepare to hear what they have to say?
So what I would say is, I understand the confusion everyone had, because a lot of people were told that if the growth rate of inflation falls, mortgage rates should fall kind of one-to-one. That's not the case. Also, we have to remember global bond yields are higher now than what they were in the previous decade. So we're dealing with a different kind of set of variables this time around versus the previous decade. Always remember that the labor market is key. And if jobless claims start to rise, the 10-year yield and mortgage rates will go down with it. They don't care. They will not wait for the Federal Reserve. We saw this in 2022, late 2022 to early 2023, right? Inflation was high, right? The Fed was still hiking, but mortgage rates went from 7.37% to 5.99%. That's because the world markets were having stress. The dollar was too strong. London was going to lose their pension funds, the Bank of Japan intervention, the Fed's recessionary indicator. All those things came into the macro play, and mortgage rates went down. But unfortunately, just for myself, I didn't think we were going into that recession yet. So we had to create that Gandalf line out there. We're not going to break under this level. And we've gone up from there since then. So always remember, focus on the weekly jobless claims data. The labor data is key. The Fed has moved the ball from single mandate to dual mandate. And verbiage is very key now, more than anything else. Even if they cut 3 times right now, how they talk about, being less restrictive to neutral could give a little bit of more clear way to the bond market. But as of right now, the 10-year yield being between 3.80 and 4.25 for most of the time looks about right. We're just at a key level right now. I think the last print I saw was about 4.29%. We break above that 4.34% level, it becomes a problematic issue in terms of, we don't know how the direction of the bond market will go and what the Fed's reaction will be that. But we do know for a fact that they have started using the term very restrictive policy, and the labor data has changed right in front of them. It's different when job openings were at 12 million and wage growth is still going higher, and the job quits percentages is very high. All of that has changed. Wage growth has slowed down. The quits percentages is pre-COVID. The labor market, the job market is, not shedding jobs or anything, but the growth rate is cooling down as it should. So let's focus a little bit more on labor and not be so prone to the inflation data, because obviously now we've seen the decline in the 12-month average of inflation data, and it hasn't brought rates down, right? But the one variable that is still holding everything up is the labor market data. And I'd say claims over everything else at this stage of the cycle.
Is there any particular cause that pushed the labor market to take the turn that it did based on what you've been assessing?
So when we go back to all my economic work and I started writing for HousingWire, there was a COVID-19 recovery model written on April 7th, 2020. So we retired that on December 9th, 2020 as well. So then it was the labor markets we're going to have a very, very tight labor market here. Job openings are going to get to 10 million. It did. It got up to 12 million. But over time, the jobs number should cool down by itself. And I think this is where the confusion is at. I believe that we should be trending between 140 to 165,000 per month. Once we get into this 157 million to 159 million, we're kind of there, but the job growth data is still a little bit higher than I anticipated. That is pretty normal, right? So people see the jobs data slowing down as, okay, we're going into recession. That's not been a correct call. In fact, the people that have been telling you this, that it's the labor market's breaking, have been wrong for 12 months now. The labor market breaks when jobless claims starts to tick up because you have more people unemployed, right? The job growth data is still outperforming my estimate. So I don't want to be that person that wants to tell you something that you want to hear, right? Because I see a lot of people say, oh, the labor market's terrible. Everything, all these people are laying off everything. And guess what? We go back to World War II. The jobless claims data tied to the civilian labor force, the percentage, you divide that. There's been a certain percentage that has to happen. It breaks every single time. It has not even budged toward that area yet. So there's a difference between the labor market slowing down and being less tight than breaking. Breaking is, okay, the 10-year yield's going down lower. So I'm trying to explain to people why mortgage rates are still high. The spreads are still bad. The spreads being bad and mortgage rates being high, again, is a policy choice, right? Go back to Kashkari. 6% mortgage rates are a problem. When mortgage rates started to come down below 7%, guess what? The Fed came out, no. No 5 to 6 rate cuts, right? The reason why they're afraid of housing is because in the 1970s, housing was booming back then with the jobless claims low and the unemployment rate low. That's why they not the biggest fans of housing. Now, I would argue that if you take the quits percentages, the unemployment rate is technically a little bit higher than what we have right now. That means the labor market isn't as tight. They have not brought that up one time. That's where I'm a little bit puzzled because the Federal Reserve members know this, right? With a quits percentage where it is right now, the unemployment rate is technically higher than what it is currently. That really should matter in the discussions. They are purposefully leaving that out of that because that would force them to be probably a little bit more dovish on their aggressive talks, and they don't want to do that yet. So if I had all the Fed members out here, I go, listen, the quit percentages are low enough to where the unemployment rate is actually technically higher. So doesn't that mean you have to become more neutral at this stage? That's what I would ask them. And I don't think they would even answer that question the way I want. They want to kind of keep things as restrictive as policy until they can see jobless claims rising. And then they'll go, okay, now we're going to go into neutral. The 10-year yield goes down, mortgage rates go down. That boosts housing demand. And they have that to rely on. And I hearken back to one of the Fed presidents who just left Bullard. And he said, we believe that the long end of the bond market falling will do a lot of our work for us. And he's correct in that. They're counting on the 10-year yield falling at some point and helping housing. We're just not there yet. And I would just highlight the jobless claims data as the big variable here.
Well, we kind of went around the world. Is there anything that we didn't touch on that you think should be addressed before we let everybody go?
Just, by the time this podcast comes out, the tracker article is already out. And again, I think the positive story for 2024 is inventory is growing year over year. It's not spectacular. It's not great. The new listings data is not stressed or any way, but this is what we want. We do not want active inventory to get anywhere back to March of 2022. It's Altos data, HousingWire, single families, which was 240,000 back then. That was a savagely unhealthy housing market. We want to stay away from that. So growth in inventory, good. Why? Because it creates a buffer. Why do we want a buffer? Because if mortgage rates fall back down, guess what? Inventory does not typically grow in that environment, unless it's like some job loss recession or some credit boom bust. We don't have that marketplace anymore. So even mortgage rates late 2022 going down to 5.99% in 2023. Look what it did. It created the seasonal bottom to happen in April 14th, right? 6 to 8% mortgage rates in 2023 led to 6% home price growth. My God, why? Because active inventory is still low. So embrace it, love it, hope for more of that. Everything looks very stable on that front. Of course, in Florida, especially the areas that were hit with hurricanes, that's a whole different story. But in general, the housing market is in a much more stable spot than what it was, I would say, in 2022 when we had the biggest and fastest home sale crash ever recorded in history. Just look at the existing home sales data. It really hasn't gone anywhere for well over 13, 14 months now.
Well, we'll be really interested to see your reaction to the meeting next week, of course. Logan, thank you for taking the time as always. Really appreciate it.
Pleasure to be here.